December 1973. Drivers in New Jersey wait 3 hours in line for 10 gallons of rationed gasoline. Within a year, American prices are rising at nearly 12%, the fastest pace since the 1940s. 50 years later, in 2022, it happens again. 9% inflation, gas station signs in the news, the same anxious headlines. Inflation doesn't drift. It moves in waves. And the past half-century shows exactly how those waves build, break, and return. Put 60 years of American inflation on one chart, and you don't see a flat line with noise. You see swells. Twin Peaks in the 1970s. A long, calm lagoon from the mid-1980s to 2020. Then a sudden wall of water in 2021. So here's the framework for today. Every inflation wave needs two ingredients. A shock, something real, like oil, war, or a pandemic, that pushes prices up. And an amplifier, the psychology and policy that decide whether the shock fades away or feeds on itself. Shock times amplifier, that's the size of the wave. Keep that formula in mind as we walk the timeline. The backdrop matters. Through the late 1960s, America ran hot, spending heavily at home and abroad while money stayed easy. By 1971, with inflation already irritating, President Nixon simply froze wages and prices by decree. The freeze felt great, and it worked, briefly. But it was a lid on a boiling pot. Then came the shock. In October 1973, Arab oil producers embargoed the West. Crude oil roughly quadrupled, from about $3 a barrel to about $12. And energy is in everything. Fuel, freight, plastics, fertilizer. So everything moved. When the price controls came off, all the suppressed pressure exploded outward. U.S. inflation hit about 12% in 1974. The UK, with weaker defenses and wage deals indexed to prices, saw roughly 25% by 1975. A new word entered the dictionary, stagflation. Rising prices and a stagnant economy at the same time, which the textbook said wasn't supposed to be possible. And then the amplifier kicked in. Workers, expecting higher prices, demanded raises. Firms, facing higher wages, raised prices again. Round and round. Expectations had come unanchored. And that, it turns out, changes everything. 6 years later, the sea still hadn't calmed, and the second shock hit. The Iranian Revolution knocked out a major oil producer, and crude more than doubled again through 1979 and 1980. It was the same type of shock as 1973. But now the amplifier was fully armed. After a decade of broken promises, nobody believed inflation would ever come down. So households bought early, expecting higher prices later. Buying early created shortages, which raised prices, which proved everyone right. U.S. inflation peaked at about 14.8% in March 1980. That's the core lesson of the 1970s. The second wave was worse, not because the shock was bigger, but because belief had eroded. Unanchored expectations turn every splash into a swell. In August 1979, Paul Volcker took over the Federal Reserve with a single conviction. Inflation would not die until people believed it would die. So he tightened money until interest rates went where they had never been. By 1981, the Fed's key rate briefly touched around 20%. 30-year mortgage rates reached roughly 18%. The economy buckled twice, with back-to-back recessions in 1980 and again from 1981 to 1982. Unemployment hit 10.8% in late 1982, the worst since the Great Depression. Home builders mailed Volcker 2x4s from houses they couldn't sell. Indebted farmers rolled tractors into Washington in protest. But the wave broke. Inflation collapsed from about 14% to around 3% by 1983. And crucially, people believed again. Volcker had bought back the Fed's credibility, and paid for it with the deepest slump in 40 years. The lesson is brutal and simple. Once expectations come loose, re-anchoring them costs years of pain. It's cheapest to never let go in the first place. Then came 20 years of glassy water. Economists literally call it the Great Moderation. Inflation across most rich countries settled between about 2 and 3%, and mostly stayed there. Four forces flattened the sea. Central banks became independent and credible, with New Zealand introducing the first explicit inflation target in 1990, and nearly everyone copying it. Globalization poured cheap manufactured goods into Western markets. Technology cut costs relentlessly. And wage indexation, the automatic spiral machinery of the 1970s, was largely dismantled. But calm water has its own traps, and Japan proved it. After its late 1980s bubble burst, Japan spent 2 decades fighting falling prices. Deflation sounds pleasant, but it's toxic. Shoppers delay purchases, because everything will be cheaper next year, and debts grow heavier in real terms. Switzerland, meanwhile, showed the gentler mirror image. A hard currency and low, stable inflation, decade after decade. So waves can undershoot as well as overshoot. Then, a genuine puzzle. After the 2008 crisis, central banks created trillions through quantitative easing. Prominent voices predicted runaway inflation, even hyperinflation. Instead, inflation spent most of a decade stubbornly below the 2% target. Why? Because the new money mostly sat inside a wounded banking system while households paid down debt. Money that isn't spent doesn't chase goods. No spending, no wave. That strange decade taught a lesson that 2021 would complete. It's not the printing. It's whether the money actually moves. Then everything hit at once. The pandemic snapped global supply chains at the exact moment roughly $5 trillion of U.S. relief money landed on households and businesses. Too much money chasing too few goods, the oldest recipe there is. And this time, unlike the 2010s, the money moved. Officials first called the price rises transitory. Then Russia invaded Ukraine in February 2022, and energy prices erupted, especially in Europe. The wave crested at 9.1% in the US in June 2022, a 40-year high. The UK peaked above 11%. The euro area above 10%. And Switzerland? About 3.5%. Same global shock, utterly different waves, because the amplifiers were different. The strong franc in Switzerland's energy mix damped the swell. Central banks moved at Volcker speed this time, delivering the fastest rate hikes in 4 decades. And here's the remarkable part. Inflation fell back toward 3% by 2024 without mass unemployment. Long-run inflation expectations barely budged through the whole storm. Why was it so different from 1980? Because this time, the anchor held. For decades of credibility, bought at Volcker's terrible price, meant almost nobody believed 10% inflation was permanent. The wave broke against the seawall his era built. Line the episodes up, and each one leaves a lesson. 1971 teaches that price controls are a lid, not a cure. 1973 teaches that shocks start waves, but easy money feeds them. 1980 teaches that once belief goes, every shock doubles. 1982 teaches that credibility is bought with recessions, the most expensive purchase in economics. The Great Calm teaches that anchored expectations shrink every wave. Japan teaches that the sea can also sink too low. The 2010s teach that printing without spending isn't inflation. And 2021 teaches that shocks will always come, but a trusted anchor turns a tsunami into a rough season. Different decades, same physics. Shock, times amplifier, equals wave. So when prices surge again someday, ask the 2 questions this whole timeline teaches. First, what's the shock, and is it fading or feeding? Second, is the anchor holding, do people still believe in stable prices? Those 2 answers will tell you more than 100 headlines. If you want to understand the next cycle before it arrives, subscribe. Next time, the credit cycle, and how borrowed money quietly builds every boom, and every bust. This is educational content only, not financial advice. Always consult a licensed professional before making financial decisions.